You know, when it comes to the stock market, you hear it all the time. History repeats itself. And yet somehow, investors almost always find a way to convince themselves that this time, it's different. The legendary investor Sir John Templeton had a name for that. He called them the four most expensive words in the English language. And man, was he right. There is no faster way to blow up a portfolio than with blind optimism that you've mistaken for genius. And that idea is really the core of what we're going to unpack today. The danger of ignoring patterns that are staring you right in the face.
And he wasn't the only one. Jesse Livermore, a total pioneer of trading, put it even more bluntly. He knew that human nature, hope, greed, fear, it's all just part of the game, and it never changes. So with that in mind, let's take a look at a stock market bubble that most people have forgotten. One that looks, well, kind of disturbingly similar to what we're seeing right now.
And no, I'm not talking about the dot-com bust or the 2008 financial crisis. We're going to rewind the clock all the way back to the early 1970s to look at this group of stocks they called the Nifty 50. And when this bubble popped, the market crashed 50% and didn't get back to even for 8 long years. So to really get the Nifty 50, you got to understand the vibe of the era. I mean, picture it. America in the late 60s was just coming off this 20-year economic party after World War II. Factories were humming, the suburbs were exploding, and people just felt invincible. The market had been on an absolute tear for 2 decades straight. Life was good. Optimism was through the roof. And all that optimism led to this new and frankly dangerously simple way of thinking about investing. They called them one-decision stocks. The whole idea was that you could buy into these companies that were so powerful, so dominant, that you literally only had one decision to make: when to buy. The thought of ever selling them? People thought you were crazy.
And listen, these weren't some small speculative stocks. We were talking about the bluest of the blue chips. Absolute household names. Companies like Coca-Cola, McDonald's, and Polaroid. Investors looked at them and saw bulletproof fortresses, just stable, cash-gushing machines that were going to grow to the moon.
Okay, so this is where things start to get a little unhinged from reality. At the time, the average PE ratio for the entire stock market was about 15. Totally normal, totally reasonable. But this never-sell mania around the Nifty 50, it pushed their average valuation to a jaw-dropping 42 times earnings, a number that just doesn't make sense in the real world. But hold on, because if you look at some of the individual companies, it gets even wilder. Polaroid was trading at 90 times its earnings. McDonald's was at 86. I mean, these stocks weren't just expensive, they were priced as if the basic laws of financial gravity just didn't apply to them.
And what's the result of everyone piling into the same handful of stocks? You get this. At their absolute peak, these 50 stocks, just 50 of them, made up a staggering 45% of the value of the entire U.S. stock market. Just let that sink in. Nearly half the market's weight was resting on the shoulders of just 50 companies.
Because, as we all know, what goes up eventually has to face the music. And between 1973 and 1974, reality didn't just knock on the door, it kicked the door down. And it wasn't just one thing. It was a perfect storm. The dominoes just fell one after another. An oil crisis quadrupled gas prices. Inflation, which had been chill at 3%, suddenly spiked to over 11%. Unemployment doubled. The whole economic sugar high was officially over. And here's the thing. When the economy tanks, overpriced stocks don't just pull back a little, they get absolutely obliterated. These bulletproof stocks were just decimated. Coca-Cola down over 60%. McDonald's lost 70% of its value. And Polaroid, that old darling trading at 90 times earnings, it collapsed by more than 90%. Just gone.
And the damage wasn't a quick fix. Not at all. Anyone who bought into the hype at the top, thinking they were buying these amazing growth stocks for life, found themselves trapped. It took 8 full years, all the way until 1981, for the market to just crawl back to where it was before the whole thing fell apart.
And all of this brings us to that famous Mark Twain quote. Because if you're looking at the market today and feeling a little déjà vu, well, you're not alone. It might not be a perfect repeat, but you can't deny it. Today's market is definitely rhyming with 1972. So let's talk about that rhyme, that modern echo. Today's Magnificent 7 tech giants, they've become the new Nifty 50. They're today's one-decision stocks, and investors are treating them with that exact same just buy and never sell mentality. Does this look familiar? It should. Just like the Nifty 50 made up 45% of the market back then, today the Magnificent 7, just 7 companies, make up 36% of the S&P 500. Once again, the weight of the entire stock market is resting on the shoulders of this tiny handful of companies. It's the same script, just with different actors.
And what about their valuations? Well, you guessed it. They're also priced like gravity is just an old suggestion. I mean, look at these numbers. They're a direct echo of the Nifty 50. Microsoft at 38 times earnings, Nvidia at 50, and Tesla at a truly mind-boggling 247 times earnings. Are these fantastic companies? Absolutely. But are they also being worshipped as if they can do no wrong? Also, yes.
And this is the real kicker. Just like back in 1972, investors are telling themselves the exact same bedtime story, that these companies are untouchable, that they'll dominate forever, that they'll just grow and grow and grow. But remember, that's what they said about Xerox, and that's what they said about Polaroid. The psychology is identical. I think Warren Buffett really nailed it. Here we are, all these years later, staring at another super top-heavy market, pretending that valuations don't matter, and we're whispering those same 4 expensive words to ourselves. This time, it's different.
So that really just leaves us with one question. When you look at the parallels, the insane market concentration, the investor psychology, the extreme valuations, you really have to ask yourself, after everything we've seen from history, is this time really different?